Well, during times of high valuations in the stock market, main central banks in 2017 have bought a record $1.5 trillion in assets year to date. These calculations only include European Central Bank, the Federal Reserve, Bank of Japan, Bank of England and Swiss National Bank. Their balance sheets have now grown to $15.1 trillion, up from $14.6 trillion in April. It means that they inject $300 billion per month. If we would add other central banks, then their balance sheets would be much higher, because People's Bank of China is another main player. Now listen to this. If we would add central banks of China, Brazil, Saudi Arabia, India and Russia to the list mentioned by me earlier, then their combined balance sheets would be around a third the size of world economy. It only gets more and more ridiculous. Bank of Japan and Swiss National Bank already openly admitted that they are buying stocks. All of it only means that markets are addicted to central bank stimulus. Their asset purchases are supporting stock and bond prices. That kind of activities only create bubbles, and additionally the activities accelerate. These huge asset purchases and low interest rates definitely create bubbles. It is not only the stock market that is affected, but we need to remember that we have 35-year-old bond bull market, and bull markets do not last forever. Quantitative easing programs aim at driving up bond prices and aim to lower bond yields. They think that quantitative easing program will boost economic growth, but it will not happen. You cannot create prosperity out of thin air. Stocks, bonds and real estate need to go to their fair valuation levels. Over the past decade, the Swiss National Bank expanded its holdings almost eightfold in US dollar terms, and in the last few years, the Bank of Japan and the European Central Bank behave like they are riding on horses 24 hours per day, 7 days per week. Imagine what would happen in the stock market and in the bond market if central bankers would stop their activities. Additionally, imagine what would happen in the real estate if interest rates would go to the historic average or would be set by the free market. It only means one thing. You do not want to short the stock market unless you know what to do and unless you are very experienced. Additionally, why would we need to short the stock market in that kind of environment if there are other places where we can park our money and wealth? I need to repeat myself. All of the combined balance sheets of the biggest central banks are around a third the size of world economy. They are around a third the size of world economy. Imagine that. All of it affects every investor enormously, and what worries us the most is that when these bubbles will burst, one way or another, people who caused all of the problems will blame capitalism and free market for all the mess. You need to know that we just simply do not have a free market. You do not have a free market when you have all the rules, regulations, high taxes and constant interferences in the economy.